The overriding objective of F&C Investment Trust is to provide long-term growth in both capital and income for shareholders. And in practical terms, that means that we invest into listed equities and private equity. And we do so in a diversified manner. We invest into a range of underlying strategies, each of which is relatively focused, and in the listed space, each of those strategies has got a relatively limited number of stocks. So yes, we are a one-stop shop for investors looking for exposure to growth assets, and we manage strategic asset allocation, making a decision as to where to allocate and how much to allocate to each area in the listed and unlisted space. We tactically manage the portfolio, navigating to take advantage of short-term opportunities. We have underlying stock selection, clearly in each of our underlying strategies, and we provide overall risk management in terms of putting all of those components together. The trust was launched way back in 1868, over 150 years ago. So we've survived 2 world wars and numerous financial crises over that time period. There's a number of reasons why we've managed to survive, not only survive, but thrive for so long. And one of the key reasons is the corporate structure that we have. So we're an investment trust. We've got an independent board of directors who look after the interests of shareholders. And we also are closed-ended, and that means that we're not dealing with inflows and outflows, and that's particularly beneficial during times of stress when one may see outflows in open-ended equivalent funds. And that closed-ended nature means that we can be patient, we can take a long-term perspective in terms of capital allocation, and we can lock up capital as well in terms of illiquid opportunities in the private markets, for example. We're also diversified, and diversification reduces risk for shareholders. It means we don't have exposure, outsized exposure to any one particular theme. And the final point I'd make is that we've adapted and evolved, and that's been critical, clearly, not only to capture shorter term opportunities, but to ensure that we're fit for purpose in terms of meeting the needs of shareholders. China has performed poorly in equity market terms in 2021. It's actually declined in value year to date compared to the US, which has gained by around about 20% in terms of the broad market. Several reasons why China has lagged so far this year. Firstly, the economy has not performed as well as had been expected. It's been disappointing in growth terms. There's also been some pressure in the property market, where there are concerns about excess levels of debt, potential defaults, and generalized financial stress. But also the Chinese authorities have taken a number of steps in terms of tightening regulation across a range of different sectors, and that includes internet, it includes property management, it includes food delivery, and also online music. So a range of different areas have been affected. And this is about authorities, to some extent, taking back control, the public sector taking more control of what's happening in the private sector. And that links into the notion of common prosperity, which has been much discussed in China recently. And that's about essentially sharing the benefits of growth more widely across the population. So these actions that authorities have taken in China have worried investors, created a level of uncertainty as to what companies and sectors may be next at risk. And it obviously follows on from the latter part of 2020 when Jack Ma of Alibaba largely disappeared from public view and the IPO of Ant Financial was pulled. So there's been a trend which has emerged in recent months in China, which investors have become quite concerned about. And for the trust, we've been quite light in terms of our exposure to China, and it was reduced earlier this year, so it has not been problematic for our performance. Inflation is a very significant issue in markets right now. We've clearly seen a marked upturn in terms of headline and core levels of inflation across the developed and emerging world. It remains to be seen whether this is a transitory phenomena or not. My sense is actually it's certainly less transitory than had been hoped, and inflation will be stickier than had initially been assumed. We do expect that inflation will end up being higher post the pandemic than it was coming into the pandemic. And we're likely, therefore, in 2022 to be in an environment of robust global growth, still higher than target inflation, but very loose policy in monetary terms. And central bankers are going to respond to that by some withdrawal of liquidity and the raising of interest rates. And to the question on inflation protection, equities do provide inflation protection because corporates can pass on, in many instances, some of the rise in input costs that they may suffer to the end consumer of the products or services that they offer. But within the market, my sense is that we will have more balanced performance. And we've seen some of that in the course of the last 12 months or so, where the previous leading areas of growth and technology have still performed very well, but it's been a much more balanced market in terms of financials and commodities, providing better returns. In an environment of rising interest rates and inflation, I would expect that that trend will persist. It's been a very strong year for shareholders in terms of return. We've had good returns in terms of our underlying net asset value growth, and our share price has performed strongly. So there's a lot of highlights, thankfully, over the past year. But once again, the US market and our US exposure has been the area that has led. It's performed very strongly as it has done in recent years. And we're fortunate that we've got over half of our portfolio assets invested in US listed equities. But private equity is also, I think, one of the highlights of the course of the past year. It's actually outperformed not only listed equities in general, but the US market. So delivered very, very strong return. And in recent years, we've made quite large commitments to private equity. We have around about 10% of the portfolio in unlisted private equity exposure. And it's been really pleasing to see not only uplifts in terms of valuation of those recent investments, but actually realizations beginning to come through. And just one example of that is a company that we bought in the early part of 2018. It was a co-investment into an unlisted private company called Pet Network, which operates in Southeast Europe. In terms of, it's basically a retailer for pet supplies. It was very robust through the pandemic. It's performed extremely well in operational terms and also through acquisitions. And we actually realized that investment earlier this year, making over 4 times our initial capital on that investment. So it's really pleasing to see that kind of progress in terms of some of those commitments that have been made.